You know, in the entire world of investing, there's this fundamental battle being fought every single day. It's really a clash of philosophies that boils down to one huge question. Do you try to beat the market, or do you just become the market? And trust me, this one choice, it pretty much defines your entire journey as an investor.
So let me ask you this. Think about it for a second. Is it better to just grab a seat, buckle up, and trust that the whole economic engine is going to carry you forward? Or are you the type to get into the cockpit, convinced you have the skill to navigate all the turbulence and find those shortcuts to a better destination? This is the core dilemma every single one of us has to face.
And that choice, right there, is what we call the investor's dilemma. It pits two completely different strategies against each other, passive versus active management. What's so great about looking at it this way is how clearly it frames the debate. See, the passive approach, it's really an act of humility. It's basically saying, look, the market is this powerful, efficient beast, and trying to outsmart it is a fool's errand. I'll just write it. But the active approach, that's all about conviction. That says, you know what? The market makes mistakes, and with the right expertise, I can spot them and profit from them.
Now, the entire passive philosophy is built on this one powerhouse of an idea, the efficient market hypothesis, or EMH. Here's the thinking behind it. By the time you hear a piece of news, good or bad, it's already baked into the stock price. The market has already reacted instantly. So according to EMH, trying to find an undervalued stock is kind of like trying to find a $10 bill on the floor of the stock exchange. It's not going to be there. Someone else has already picked it up.
So if you subscribe to that idea, what's your game plan? Well, that brings us to the passive playbook. And the rule is simple. If you can't beat the market, you join it.
The main tool in the toolbox here is indexation. And it's an elegantly simple idea, really. You're not trying to pick winners or losers. You're just building a portfolio that's designed to be a mirror image of a market index, like the S&P 500, which, represents the 500 biggest companies in the US. Your goal is just to get the market's return. No more, no less.
Okay, so how do they actually do this? Well, there are a few ways. Full replication is the most direct. I mean, you literally buy all 500 stocks in the S&P 500 in their exact proportions. As you can imagine, that's super accurate, but also pretty expensive to manage. A more common method is sampling, where you buy a representative basket of stocks from different sectors to mirror the index. And then there's optimization, which uses these powerful computer models to create the best possible mimic with the fewest stocks possible.
So here's the crucial part, the big trade-off. The huge advantage of passive investing is that it's cheap. You're not paying for high-flying fund managers or massive research teams. And since the data shows that most active managers fail to beat the index over the long run, why would you pay the extra fees? The downside, though, is just as clear. When the market tanks, you are guaranteed to go down with the ship. There's no pilot to try and pull up on the controls.
But what if you believe you can be that pilot? What if you're thinking, no way, I can do better? Well, that brings us to the other side of the coin. Welcome to the active game.
Active managers usually fall into two big camps. You've got your top-down managers. Think of them like helicopter pilots, surveying the whole landscape. They look at global economics, interest rates, political trends first, and then decide which industries look promising before they ever pick a single stock. Then you've got bottom-up managers. They're more like treasure hunters. They pretty much ignore the big map and just focus on digging for individual gems, those fantastic companies they think will succeed no matter what the rest of the economy is doing.
Let's break down that top-down process, because it's a really logical funnel. First is asset allocation. Based on the world economy, should you be heavy in stocks or playing it safer with bonds and cash? Second, sector selection. Okay, if you're bullish on stocks, which specific industries are ready to pop? Tech? Healthcare? And only after all of that do you finally get to the last step, picking the actual companies within those chosen sectors.
And check this out. This is a key tool top-down investors use, the investment clock. As you can see, it links the economic cycle to specific types of investments. So for example, look at the top where it says start of a bull market. The clock suggests that as interest rates fall coming out of a recession, things like bonds and bank stocks tend to do really well. Then, as you follow the clock around to the growth phase, the focus shifts. It's basically a roadmap for trying to align your portfolio with the economic weather.
But it's not just about top-down or bottom-up. Active managers have very different philosophies about what actually makes a great stock. These are their styles, and they're super important to understand. So let's do a quick fire round.
First up, value investing. This is pure bargain hunting.
Value investors are looking for solid, established companies that, for whatever reason, the market has unfairly beaten down. They believe the company's true intrinsic value is way higher than its current stock price, and they're willing to wait for the market to wise up. Then you've got its high-energy cousin, growth investing. This isn't about finding bargains, it's about finding rockets. Growth investors are looking for companies with the potential to just dominate their industries and produce explosive, above-average earnings. They don't really care what a company is worth today, they're betting on what it could be worth tomorrow.
And finally, there's momentum investing. This style is all about trend following. The philosophy is super simple. Winners keep winning. Momentum investors find stocks that are already on a strong upward trend and just ride that wave, believing that the crowd's enthusiasm is going to keep pushing that price higher and higher.
So you might be thinking, okay, this sounds pretty black and white. You're either active or you're passive. But in the real world, a lot of savvy investors are finding ways to kind of blur those lines.
And that is exactly where a strategy like core satellite management comes in. It's a best-of-both-worlds approach. You build the big core of your portfolio with low-cost passive index funds to capture the market's return. Then you use these smaller satellite portions to make active, high-conviction bets on specific managers or stocks you think will outperform. You get the stability from the core and the potential for that extra juice from the satellites.
And while a lot of those satellite investments are in stocks, the really dedicated active managers, well, they play a much more complex game. They make these tactical maneuvers in entirely different markets, especially in the world of bonds, where subtle shifts can create some huge opportunities.
Okay, so this is where active management gets really tactical. A bond manager, for example, might use a strategy like duration switching. If they think interest rates are about to rise, which is bad for bond prices, they'll adjust their portfolio to be less sensitive to those changes, protecting their capital. Or riding the yield curve and bond switching. These are similar, expert-level plays, all designed to exploit tiny shifts in the bond market that passive investors just have to ride out. This is the active game at its most granular level.
So, after exploring both of these playbooks, the passive approach of becoming the market and the active game of trying to beat it, we're right back where we started. We're back to the original question. What's your move?
At the end of the day, it all boils down to this. The passive route gives you simplicity and low costs, but you'll never do better than average. The active route gives you that thrilling potential to outperform, but it comes with higher fees and the very real risk that you'll do worse. And that hybrid approach, well, it tries to strike a balance, giving you a little bit of both. There's no single right answer here, of course. It all depends on your stomach for risk, how much you're willing to pay in fees, and your fundamental belief in your own skill versus the market's overall efficiency. So, now you know the playbook. The only question left is, what kind of player are you going to be? The game is waiting.